Dr. Jerome Powell once again is becoming extremely hawkish, causing the dollar to skyrocket and most assets to sell off. And now the S&P 500 and the stock market is sitting at very, very key levels. So we're going to speak on all those and much, much more in this video. Make sure to watch to the end because I'm going to highlight a few key charts at the very end of this video. If you don't follow me yet on Twitter, go ahead and check me out at Jeff Seckinger on there. We post really valuable threads on there all the time about what's going on with these rate hikes, CPI data, and a lot of macro data as well that are really key to making intelligent decisions. As far as what has happened this week, again, the Jerome Powell, Mr. Doctor, has once again become pretty hawkish, and hawkish means that, hey, inflation is bad. It keeps hinting that it's going to take forever to come down to 2%, which is their target, and saying that now if the economic climate is supporting, they're going to continue to increase actually rate hikes back up to 50 basis points, and they're not going to be slowing down the hikes until it starts to roll over. And when I say it, I'm talking about inflation. So they are hinting at that. Now the market is actually projecting a 50% chance that they will lift interest rates by 0.5 percentage point later this month, which would not be very bullish for markets. Again, that tightens credit markets. It makes debt more expensive, so people borrow less money because it's more expensive. And then after people borrow less money, they spend less money, businesses make less money. And most of the time, cash flows come down, and then equity prices and ultimately a lot of other assets will come down. You see that in real estate as well. You know, the 400K house, if you were going to buy that about a year ago, now you can only buy a 250K house, which is obviously quite insane. If you haven't followed me on Twitter yet, go ahead and check me out at Jeff Seckinger on Twitter. The dollar is once again rebounding off of this key level, which was previous resistance, now flipping it into support. We'll see. I would not be surprised if we come back up to the high 107s. Now let's go ahead and check the S&P 500, which again is at a really key level. And the reason why is we had this broadening descending wedge, okay, this entire year practically. Now, one of the key zones that I am watching is 42.75. So that was where I believe that we were going to get rejection off of for a slight correction, but we actually had it a little bit sooner. And we had that correction probably because Jerome Powell, once again, becoming hawkish with his rhetoric. Now, we've been in this broadening descending wedge, and once it finally broke, we had a really big, wick right here that pretty much faked everyone out, coming above the 200-day moving average. And now we have really officially broke and confirmed that. Now, if you know anything about traditional technical analysis, when there is resistance, the more times you touch it, the weaker it becomes. And usually when you break it clean, like we just did, it will flip into support. So you'll have a breakout. Okay, it'll free up a lot of liquidity, then it'll come down, retest that previous resistance, bounce off of it for support, and then it will head higher. Now, that is exactly what is happening right now. We broke out, came back, we pretty much tested it very, very close, but the key level is we are sitting right on the 200-day moving average, which is an extremely key level. When we're below the 200-day, we're technically in the bear market. We're above the 200-day, we're technically in a bull market. But anyone that is, a technical trader watches the 200-day moving average, especially on their longer term type swing positions. And this is an extremely key level. If it holds it as support, that is huge. If it starts to break down past the 200-day moving average, I am going to flip my stance and start. And especially if we come back, below the 200 and come into this wedge again, I will definitely be more bearish than bullish. Right now, I'm still more continued bullish than bearish. And the reason is for many, many reasons, which we've discussed in a lot of my previous videos, which still stand true. And we're actually going to cover one at the end of this video. But first, I want to help you understand. Let's just look at, previous sell-offs. Obviously, whenever we discuss history, everything is not always going to be the same, right? People are always like, oh, well, the macro climate was different then. Well, no kidding. There's always going to be macro climate that is different. But if you're never comparing anything to anything in the history, it makes it very, very difficult to formulate any type of opinion. So a lot of the times what you want to do is you want to look at a lot of historical data and then say, okay, this was kind of the closest to the climate that we have now, but then we're pulling this piece maybe from '08 and from '01, and then we can kind of conglomerate and make a decision based on what we think is most likely to happen based on a lot of different data, once again, comprised. So we had kind of the same thing. We had resistance back in 2000. We popped right above. We used, the 200-day moving average, perfectly kissed it as resistance and came down, and we never came above the 200-day moving average until, the major, actually we peaked our head right above here, excuse me. So we had a little bit of a fake out here. We traded here for quite a few days above the 200-day moving average until we actually reached bottom further in 2002, which obviously that sell-off was quite dramatic. Let's just go from the top of resistance. This one was all the way down to, over 50% type sell-off, almost 51%. Okay. And then once we formed pretty much like a triple bottom and then came up strong outside of the 200-day moving average. Now, if we go into 2008, similar thing. Okay. We had resistance, which tapped 4 times up here. We were, down below the 200-day moving average. We came up and kissed it. We never came above the 200-day moving average until we officially stopped the descent, which this was, again, another 50+% sell-off. 57% sell-off. And we did break above the resistance line, but then continued to use it down here. So we had the kiss off the 200-day moving average. And then it flipped into support. You can see right here. Okay. And now if we zoom to where we're at, we are at that really key level. And a lot of times, again, the 200-day moving average is used for considerable support and resistance. Support. You can see price sustained all the way above it. Okay. And a lot of times it will hold true. So it is a really, really key level. You can see how many times it uses support, all the way up through here. And now it broke, it kissed it as resistance. This was very bearish. I was actually over in London when this was happening and I pointed this out. And now we are flipping it as support. So we need to be able to hold this. If we are not holding this line and we do trade inside this descending wedge, I am definitely going to flip a little bit more bearish. As far as Bitcoin goes, had that massive rally off the lows. This is typically what you see in these bear market rallies when Bitcoin comes down. We've talked about on this channel quite a lot that it's been this exact same timing from the top to the bottom in all 3 cycles to the exact day. It's literally been the exact time frame from the top to the bottom in each previous market in 2015, 2018, and then once again in 2022, and now into 2023 with this rebound. Now, you can see that we're sitting at a pretty key level, what I think is potential. So there's a few things that can happen. Number one, this could be a head and shoulders forming right now, where we've got the left shoulder, the head, and then maybe we form a little bit of a right shoulder and then retest this and come higher. Or this could be the breakage zone, where if we do break below this, we're once again at a pretty key level. And I think if we do start to break below this low, which we're pretty much sitting at right now, that there could be a significant opportunity of potentially coming down and having close to a double bottom. Unless there is wars overseas, the stock market sells off 40+%. I don't think that Bitcoin is going to new lows. I think that the lows are already in for Bitcoin. And if we do break below this, maybe we have some type of a double bottom and come down to the 16K range. But I don't think that we're heading to new lows at like 10K, which, a lot of people are still kind of sitting in their chairs waiting for that thing to happen. Now, if we were to look at 2018, okay, you would have seen that same type of thing, right? We had an entire year sell off. We had the lows here. We kind of had the U shape, a strong bounce, and then Bitcoin rocketed upwards. And then this is where we kind of had the big double test where we had, came right up. We tested, held some support here. We had the head right here, which is, potentially, maybe we're forming a head and shoulders. Comes back down, touches support, and then what do? We rocket up once again higher. So, and from that specific point where we actually, touch support, we still had another 181% move. So if the stock market is going to hold the 200-day moving average, and if Bitcoin does hold its support right now, I am definitely really bullish. I'm actually, in fact, in a long position right at support right now on Bybit. So I do use Bybit for leverage trading, and I actually am in a long position right now on Bitcoin right at that support, which we were just talking about, which is literally right here. So obviously somewhat of a close stop right outside these swing lows, not right outside, but using a decent ATR multiplier. And I do believe that I'm still, again, more bullish than bearish in the short term. Not financial advice, but just my personal opinion. Now, let's go ahead and dive into some stats. I've mentioned this, we talked about midterms and stuff, how there's never been a 12-month period of time after midterms where the stock market was negative. And also, people don't understand. People are always waiting for the Fed pivot to start buying. Markets, again, are forward thinking. So they're pricing in data, 9 months ahead of time. So what do? They get excited when they believe that the rates are the rate hike is slowing down because they're pricing in the pivot. And that's why we saw the rally outside of the broadening descending wedge. We saw this move because, oh my gosh, Jerome Powell is slowing down the rate hikes. So let's start pricing in the potential pivot. Okay. And that's what the market was doing. And what people don't understand is that happens far in advance from what retail typically thinks. So if we look at the market, what happens when, the rates start to slow down, and especially when the rates are paused, markets love that for some reason. Markets actually rocket because, again, they're pricing in the pivot in advance. But then when the pivot actually comes, which you can see the interest rates at the bottom in this blue line, when these rates go down, when the pivot actually happens and interest rates come down, that is when we've seen a 36, a 48, a 27, a 51, a 58, and a 35% sell-off. And now we're into 2023. So when is the Fed going to pivot is the question. And that is why I am more bullish in the short term than I am, bearish in the short term. But don't get me wrong. I am very bearish in kind of the immediate, longer term. If you were to say, it depends what your time frame's on. I'm really thinking bearish in the next, year or so. When the Fed actually pivots, I will become a lot more defensive. But as of right now, if we're trading above the 200-day moving average and holding it as support, and the Fed has not actually pivoted yet, I am definitely a little bit more bullish than bearish. Okay, another thing, this is real estate is kind of the dinosaur, and actually real estate in Miami, which is where I currently live, is up 60% still from COVID highs, and it's still up I think like 15% year over year, which is the number one, I believe, in the country for real estate in the entire United States as far as cities go. And we're still seeing nationwide, though, a really big mortgage collapse. Like there's pretty much no demand to go buy real estate because all the demand was massive in 2021, and it has really slowed down into 2022 into 2023, and it's at this lowest level in 28 years. Okay, home buyer demand is at its lowest level in 28 years, which is pretty low and pretty astonishing. If they keep rates high, there's pretty much no saving the further decline of real estate prices, because if you think they hold rates for the next high for the next year or so, that's going to be very, very difficult. Because again, the person that could afford a $400,000 house, now they can only afford a house that's $250K. Do you think that they're going to try to rush into buying a house for $250K when they're like, I'll just wait for rates to come down? Everyone has the same mindset. I will just wait for rates to come down. So right now, usually cash is quote unquote trash, but cash is king when rates are going up, debt is more expensive, and people are fearful. Last thing I want to talk about, this is also really bearish, which we've talked about before. The blue line is consumer loans, just like credit cards, other revolving, debts. Okay. And you can see during COVID, we had a really healthy move with consumer loans where the blue came way down. Okay. And then on the red side, which is personal savings, personal savings has gone way down. So it went way up because we spiked all that helicopter money during the pandemic, right? So government gave a bunch of money for free. Then we saw a bunch of people get money, they paid down their debt, so their debt came way down. Now the inverse is happening, which is very, very unhealthy. And there's been people talking about, hey, consumers are really healthy right now. But in fact, in reality, and they're healthy because they're spending money. Well, they're probably, quote unquote, healthy spending because they're just racking up a bunch of debt, which we can obviously see is going very, very rapid, which is not sustainable. Something has to happen. Either a bunch of people are going to default and declare bankruptcy, or the governments are going to have to print more money. And now the X factor right now, in my personal opinion, on why we see maybe a bigger sell-off, then the Fed steps in, prints more money, because they're actually dropping M2 right now. M2 money supply is actually coming down, and they're also decreasing their balance sheet. So there are a lot of bearish things happening, but typical psychology of how markets work, if the Fed is starting to slow hikes, you will see a nice rally before the ultimate demise and destruction of what they just did with raising rates to the fastest degree that they ever have in the history of the United States. All right, let me know what your thoughts are in the description and comments below. Thanks so much for watching. I'll see you here on this next video.